Hi, thanks so much for joining in. You're watching the Mutual Fund Show, and my name is Mathew. This, of course, is NDTV Profit. This show gets you actionable insight in everything related to mutual funds. So if you've got a question as to which mutual funds to select, but more importantly, which strategy to follow, then this is the place for you. On today's program, we're going to be discussing a very old discussion, which is, should you go for the growth approach or should you go for the value approach when you're getting into equity mutual fund schemes? And we look at the performance of these two approaches over the last several years and try to get you a sense as to which you should espouse and in which situations. And in the second part of this show today, we'll be talking about ESG funds. They were launched with a lot of fanfare, but unfortunately their performance has left a little bit to be desired. We talk about why that is and whether or not they still should find a place in your portfolio. Joining me in studio this time around is Mohit, the co-founder and chief executive officer of Moneyfront, and Prathiba Girish, the founder of Finwise Personal Finance Solutions. Thank you so much to the both of you for taking the time. Always a pleasure. This time it's especially a pleasure to have you in studio.
Thank you so much.
Yeah. So let's start with the first conversation, which is growth and value. This is something that is a very old conversation. First of all, give our viewers a sense of how old this conversation is. Mohit, in your experience, I'll start with you and then I'll go to Prathiba.
Okay.
How often have you been asked this question about whether should I go for growth or should I go for value?
Look, I think since the time humanity was born, and I think
that far back.
Yeah, because we talk of Warren Buffett's and Benjamin Graham's, and that's where the entire value philosophy originated, right? So for the investing world, value philosophy was the one which actually was the right investing philosophy, which was meant to be true investing. And then gradually multiple other theorems came into play and growth became a real big thing globally, right? In India also, I think we have seen number of fund managers, fund houses espousing one philosophy or the other. But today, in today's time and age, we see a blend of everything and anything which you find under a fund house's banner. I think the AMCs have become smart enough to understand that no one philosophy ever triumphs across different market cycles. So I think a blend kind of an approach, having all different fund managers, different styles under the same banner, and then trying and running different schemes with different theorems has always worked well.
So a mix and match approach, but let's try and identify what these two mean in the first place, right? If you're talking about growth and value, and of course these are the two primary ones that people talk about, but there are, like Mohit said, mixes and matches that create different names. But how would you describe growth versus value?
So essentially, if you look at the definition of value, it is picking up stocks which are lower to intrinsic value of the stock. So you pick up something which is not, it's lesser than its intrinsic price and wait for the value to get unlocked. In growth, you're paying for the future growth. You've seen that there is consistent growth of profits, revenue, whatever you say, and there is a runway for future growth in these companies, and therefore you're willing to pay a higher PE. You're not likely to get dividends because they're investing and they're growing their business. So that's the essence between value and growth. Now, traditionally, the fund houses have either veered towards growth or towards value, and there have been pain points for the investors for a very long time in both of them. Something is done well, the other one is languishing, and therefore there is big pain point. But of late, you see even those fund houses which stood very, very strongly in favor of, say, value or growth are looking at adopting blend style, having different fund managers who will bring in different, thinking process. Both value and growth are being incorporated. I think it's a very welcome change, making the journey of investors far more pleasant and conducive to staying put.
When I asked you how long it was, I didn't expect you to go to the birth of humanity. But then at least we can say that the birth of investing, because people anyway sought to identify value early. That's the whole idea of betting on something early.
Absolutely.
But having said that, I'm sure my viewers are wondering, in the landscape as it stands right now, are there any AMCs that very clearly move towards growth or very clearly move towards value, and which fund managers over the course of the last couple of decades or 3 decades have very clearly indicated that I prefer this over that?
Perfect. So look, I think there was a time up to 5 years back when there was a very, very clear distinction in the industry. You had an HDFC AMC leading all the way on the value pack with Prashant Jain espousing it, and he was a very big philosopher of that, as in a very big proponent of that. And then you have S. Narain from ICICI. I think he's one big steadfast believer of value philosophy, and the fund house is always centered around that. The overall thought process of the fund house is centered around that. And then I think, as we've been discussing, more often than not, you see fund houses having 1 or 2 schemes with a value approach, but predominantly then they will have something with quality, something with proper growth, and these days perhaps you also find momentum as a strategy which is coming into play. So number of different approaches are coming into play, but pure play value, I would say, what we have seen is HDFC and Pru ICICI to a very large extent, and then some bits and pieces maybe in Franklin, maybe in SBI, but again, as I've said, these days everyone has all the approaches under the banner, under one roof.
So, but then the bottom line is which has worked and which has not over the last several years, and I suppose it depends on where in the last 10 years you want to start the clock, right? So talk to us about how these strategies have worked in different periods of time, and you showed me this graphic at the start, and hopefully we can pull that up on the screen as well. How have they worked?
So if you growth, we talked about value focused mutual funds, and if you talk about growth, the first thing which comes to mind is Axis Mutual Fund. Was for growth for such a long time, and they've also had the difficult part of maneuvering the last 3-4 years. Then Mirae also is now blend, but then largely growth. So if you look at the performances, say 2 things you can do. One is you look at the MSCI index, for India, MSCI India index for value and growth. If you look at it over the last 14 years, from 2010, the initial period you see, except from 2010 to 2018, except for 11 and 15, growth has done better. Sometimes marginally, sometimes substantially, but
8 years practically.
8 years. And after that is when value is picked up, and value is done better in 4 out of 5 years in the recent past. So recent memory is very strong, and now we will, we'll say value is the way to go. If you look also at if the philosophy of the fund house itself is value or growth, and you look at the large cap funds of ICICI and HDFC and large cap funds of Axis and Mirae, the verdict is split. 5 years, value has done well, as in ICICI, HDFC funds have done well. The other 5 years, Axis Mirae average has done well. So there is, I don't think there's a verdict that one is better than the other. I think it depends on the time frame.
Okay, it depends on the time frame. But then, so therefore, the most important point, which is what is the ideal approach to have? I think you pointed out fund managers themselves are realizing that not one single approach is the way to go, and they're blending. Like you said, they're moving towards momentum as well and using quant factors, some of them also to make their fund choices. So what should the investor bear in mind? Because ultimately you're talking about most investors that will choose to have a basket of mutual fund schemes, even in the equity category. How should you make your selection?
Perfect. Look, Alex, I've always believed that more important than diversifying across asset classes and market caps is diversifying across fund managers and differing investment styles, because that is what will actually differentiate your portfolio in a very, very true sense, right? So I think for investors, they have to have all kinds of approaches in their portfolio. They have to have 1 or 2 funds which are pure value kind of styles, a couple of funds which are pure growth, and maybe these days, as I told you, you will have some quality based funds, you will have some momentum based plays, you have other factors also which are getting extreme amount of prominence in the market. And if you think you can't actually go ahead and identify a good manager and distinguish him from his investing style, right, then it is always good to go passive and figure out these factors. And there are all kinds of factor-based passive indices now available in the Indian market across all market caps, right? So it's become very easy for investors to actually just simply go out and select those factor-based passive indices, which are called smart beta funds, right? And just play any kind of style which you want to play.
And those incidentally have beaten the benchmark quite handily. Over the last 5 years at the very least, right? We will come back to passive in just a bit, but what do you have to say in terms of the strategy? Because the other aspect is how many schemes should you hold? On the one hand, the advice is shouldn't hold too many, schemes, because that's not very effective. So assuming that you have to hold a small amount, how do you choose?
So you have market cap based, allocation which goes into funds. In that you can choose some of them as value, some of them as growth. Because ultimately we all know that everything will give good returns if held over a long term.
Yeah.
While that's so easy to say, it's very difficult to follow, because
And
if
it's
you
the
see
relative outperformance or underperformance, right?
Absolutely. The absolutes don't matter. Today, if large cap is doing 30%, it's still not good enough if something else is doing 60%.
Yeah.
So if there is that comparison which is there and gives you the stability to hold on to it, saying that at least something in my portfolio is doing, therefore my portfolio overall is okay. And you should build conviction before you choose to invest, and have expectations which are right. That all points of time, all funds are not going to do well. Some style will do well, something else will not do well. But hold on to them and their time will come. It makes following all these behavioral biases, getting rid of them very easy if you have all styles. So I think not too many, but if you have a flexi cap in value, then you have something else in growth.
Okay.
And that way you can balance out.
So on the market cap side, allocation is what you do. Just a last question. Should you look at value primarily, for example, as she's pointing out, in the broader end of the market, considering that these are relatively smaller companies, maybe some that are undiscovered, and on the growth side, you look at the larger, more established companies, and maybe even have like an index approach, not necessarily a factor-based approach, but allow your index allocation, like say a Nifty 50 or Nifty Next 50 kind of an allocation, take care of your growth?
Look, again, there's no right or wrong in this thing, and as Prathiba rightly mentioned, Alex, there are cycles of each of these styles. Sometimes the value cycle will play out on the large cap also, and sometimes the growth cycle will play out on the mid and small cap. Predominantly, we consider that the growth cycle is more associated with the mid and small cap segment, because that's where the larger part of growth is yet to be uncovered, right? But there is no hard-coded rule about it. But yes, to answer that, perhaps you have a passive index-based approach on the large cap side, which just simplifies your overall investing process, right? And it covers and captures the whole essence of market. And then on the mid and small cap, it's always good to go with one active, one passive, which kind of gives you the flavor of everything. If you're going on the active side with a growth kind of strategy, then on the passive side, you can perhaps choose a value style. Or if you're going on the passive with a broader indice, then on the active side, you try and figure out a fund manager who's chasing aggressive growth. So you have to just mash it up.
Fantastic. All right. We're going to talk about ESG. Now, it was launched with a lot of fanfare a few years back, and it held a lot of promise. But unfortunately, the actual numbers, if you put it in black and white, they've not really proved compelling, if you can call it that. Let's find out why. I'm joined, of course, by Mohit Gang as well as Prathiba Girish. Thank you so much, as always, for taking the time once again. Let's talk about ESG. And Prathiba, I'll start with you this time. Why haven't they worked?
There was a lot of fanfare, like you said, post-COVID environmental factors. I think people were more conscious. A lot of funds got launched at that point of time. Even today, there are only 8 funds in this category, active funds. 2 were in existence before 2020, 5 were launched in 20, and 1 in 21. So there was a lot of action at that point of time, and people expected, it's intuitive, right? Environment, social and governance. What can go wrong with this? I mean, you're bound to get good returns. But what happened, I guess, after that was the Ukraine war. And after Ukraine war, defense took off like anything, and then fossil fuels, and both of these are not included. Ultimately, the proof of the pudding is in the returns. So the returns have kind of languished as compared to large and mid cap, large cap, flexi cap, any of that, they've languished over the last 4 years. Slowly, people have kind of lost interest in it. Added to that, the TERs are slightly high. It's a niche segment, so more expenses, lesser returns. So the sheen is gone as of now. I guess only time will tell whether the measures, etc., which can be brought into place so that this will take off once again.
Mohit, what is the advice that you've given your, or people who come to you for advice? Because ultimately, like Prathiba was saying, the proof of the pudding, it has to return.
Absolutely.
And look, it was not launched as something that you are doing for the betterment of society. Absolutely. The idea was that these are entities that are ahead of their time. They're planning because ultimately they will have to change. The idea is that these companies are changing ahead of time, and so they will be held in better stead when things go bad.
Absolutely.
But that hasn't proven the case.
Look, honestly, I think as Prathiba rightly said, and as you are saying, investments finally have to yield higher and better results and better returns for investors. We obviously care about the environment, care about the highest forms of sustainability and all those things, but that's not the business which we are into, right? And that could have been taken care of well through other means and measures, whatever you do in your personal and other lives, right? From an investing perspective purely, I think India is still a developing country. We are grossly, what do you say, we are investing very heavily on infra, capex, multiple other things. Sustainability is a little far away from where, from wherever you and I are standing right now. And I think as a developing economy, we will continue to burn those fossil fuels, will continue to, perhaps because so many new companies are coming in the listed space, you will find some corporate governance issues, you will find some other societal issues, right? So it's very difficult.
One of our guests on one of the market shows pointed it out very well, right? Because if these are essentially Western concepts, and a lot of Western countries have gone whole hog and said we will ban fossil fuel, or we will ban this kind of power generation. Our government cannot afford to do that because millions are depending on a power that is primarily thermal power, and we have to burn coal.
Totally.
We can't go black, right?
Absolutely, absolutely.
You know,
so there's no alternative to coal. There's no alternative to thermal energy right now, right? So if your country sustains on almost 85% of thermal energy, then there's no which way you can actually ignore that possibility, right? And in such a large populace, it's very difficult to really find true to blue ESG themes, right? The measurement of ESG data also in our kind of countries is not very accurate, right? It's very difficult to say that, okay, this country is a true blue, this company is a true blue blood ESG follower and this one is not, because everyone has those chinks out here, right? So, and when you weed out the good names just because they have one or two smaller factors perhaps, right? And I think that's where you lose out on the returns, and which is what investors are looking for. And one last thing, Alex, I don't think so today the last common denominator investing in the market actually understands the concept of ESG, right? So I don't think so that retail investor coming from a B30 city who's putting in his 20, 30, 50,000 rupee application actually is aware of what ESG means and what is the fund trying to do at the end of it, and what is the differentiation he's getting by investing into it, right? So for him, it's all hunky-dory, and he just wants to get the best of returns which is available in the market. So
that's the bottom line, isn't it?
Absolutely. The passion or whatever, if you're saying that I will compromise on my returns if it's for the betterment of society, and there's large enough people telling that, then it would make sense. But as of now, we don't see that happening. The ground reality is it's not happening.
And it's costly.
It is, yeah, it is. And how do you measure? You know, everybody measures governance. You don't have to go to ESG fund for governance. Every single fund manager talks about governance in a big way. How do you measure environment and social impact? So, you know, the scores, etc., which has come in is fairly new, and it's going to take time. Maybe it'll still take off. Maybe we were really early. Maybe 10 years from now, we will say ESG is the way to go, but not yet.
Okay. So I think there's consensus. It doesn't really fit in your portfolio right now. Would you say that?
I'd rather go with a diversified flexi cap kind of a choice than going with an ESG theme, because I'm assuming the fund manager is still working on good quality corporate governance in those flexi cap funds. Also, he's identifying companies which are doing the right kind of business. So bulk of it is taken care of, right? So it's just about the environmental part, which perhaps, I think, as Prathiba said, it's a little too early.
Yeah, it's a little too early. There are a couple of queries, and I always invite our viewers to write in to us, and over a period of time they build up, and we try and take as many queries as possible. We will try and take a couple of queries today as well. The first one we're taking is from Parikshit, and he says that he's 45 years old. He says that he started SIPs in 2017 and their total value is currently 17 lakh rupees. He wants to stop his SIPs and keep the amount in those respective mutual funds for the next 15 years. He's wondering what his corpus will be after that time horizon, and will this strategy work, or should he withdraw the amount and invest in new schemes? That's an interesting concept or a question. He's been doing an SIP of 6,000 rupees in Aditya Birla Focused Equity Fund and in UTI Mid Cap Fund. So it's quite interesting that he's got only two. He's built a corpus of 17 lakh rupees, and he's looking to hold these for the next 15 years without incrementing them. It's interesting because he's 45 years old, Prathiba, so I'm not sure why he's saying that he wants to stop those SIPs.
especially since he's had a very good run and he's found the right time to invest. He's invested 10,000 a month and he has 17 lakhs as his corpus right now. So the suggestion would be is if you can continue the SIP, not only continue, step it up every year, because you're only 45, your incremental income is going to come in. So if you don't step it up, you'll possibly spend it. So it makes sense to continue investing and stepping it up. As far as the corpus goes, 17 lakhs, if it gives 12% return, should return about 93 lakhs over 15 years time frame. And if it's going to give 14% returns, which I mean, better to go with 12, it will give about 1.2 crores. So if you've built up that kind of corpus, then all the more reason for you to continue with it and build a much larger corpus.
Yeah, because he's 15 years away from retirement, one would assume, Mohit. And these are the golden years when you're earning. Of course, people say that the golden years are early, but I think that the velocity that you get in your savings is when you've built up a reasonable nest egg and then you increment it by a very large amount. How important is the step-up SIP or the step-up investment that Prathiba just pointed out? Because it kind of goes under the radar, but I've heard it described, for example, that a good strategy to have is that if you are a salaried employee, Mohit, and if your increment is taking you up by 10%, you were able to survive just the previous month with that amount less than 10%, right?
Right.
So the amount that you're getting, perhaps instead of saving 30%, you should save 40%,
right,
because you don't need that entire 10%.
Absolutely.
Right?
Absolutely.
So how do you approach it?
So look, Alex, my golden rule on this one has been, let's say if you start your career with a breakup of 50, 30, 20. 50 is your expense, which is your daily expense, 30 is your discretionary expense, and 20 is your saving, right? As you pass your age, as you move towards retirement, as you mature in your salaried jobs and everything, the equation should change, opposite, right? So 50 should be your savings and 30 should be your whatever discretionary, again it continues, and 20 should be your normal daily expenses and routine expenses, because your capacity, as you said, once you have built your nest egg, once you have your liabilities well taken care of, you're in command of your career, your salaries have increased, right, then you can save more. So your savings pool has to keep continuously increasing. It can't stay stagnant that you are saving 20% at the start of your career and you're still saving 20% when you retire. So that won't lead to any kind of a wealth creation.
Meaningful. So very quickly, because we're running out of time, a minute. This is now a very I say young at heart, I want to say, 78 years old. This is Lakshmi Narasimhulu, who's asking a question. He's got a retirement fund. He wants to invest 5,000 SIP. Can you recommend a few funds? This is now perhaps a little late in the day to start a retirement fund, but assume that he has a corpus and he's got incremental savings that he's got to make. What should he do?
All of us would like to be in his shoes. At 78, we want to invest. So if you're looking at investing at that age, we don't know when you will start withdrawing, possibly earlier than later, and therefore balance advantage fund or multi-asset fund. So you can consider ICICI balance advantage or multi-asset funds for investments, because volatility will be lower and therefore it will be easier to hold on for some time. And withdrawals can also happen earlier than in a pure equity fund.
Okay. So, and also do bear in mind that you need to have a holistic view, and this is, now we don't have all of the information, and hopefully you've allocated based on your risk profile, which is generally, you would take less risk at that age, and you keep a certain amount in equity, of course, to hold you in good stead over the next 20 years, hopefully. This brings us to the end of this particular edition of the Mutual Fund Show. Thank you to the both of you for joining in. And to you, dear viewer, thank you so much for tuning in. Always a pleasure bringing you this program. Do let us know what you think in the comment section, and stay tuned. Lots more coming up over the course of the day. This is NDTV Profit.